Farm4Profit Podcast. Take a listen, have a blast. Farm4Profit Podcast. Learn about farming while having a laugh. Farm4Profit Podcast.
Well, hey, listeners, welcome back to the Farm4Profit Podcast. Got Tanner sitting in here on what might be a solo show with a guest here. Excited to have Van Carlson join us. And he's going to get stuck with only my questions this afternoon, but excited to bring him in because our listeners, Van, have reached out with a lot of questions about insurance, but I didn't know much about what we're talking about today. So we're all going to learn side by side. But listeners, don't forget, if you've got ideas like the one we're talking about today, send them to farm4profitllc@gmail.com so that way we can get to the topics you want to hear. But Van is the founder and CEO at SRA. I'm excited to learn more about SRA, but more importantly, Microcaptive insurance, because to me, a lot of things insurance don't make sense, especially when you start throwing in acronyms, and sometimes I feel like made-up names. We're going to dive into this, but Van, you're the guy to talk to because you've got over 25 years of experience in the risk management industry, and it sounds like you know that there could be some solutions our listeners could use Microcaptive insurance for. So welcome to the podcast.
Yeah, thank you for having me on, Tanner. I really appreciate it. I'm looking forward to our conversation.
So I gave you just a little bit of an introduction. You tell our listeners more about yourself.
Yeah, so I live in the world of risk management. Pretty exciting, the sexy stuff, everything everybody wants to talk about. But no, I've been doing it for a long time, and I would tell you it's a very rewarding industry that we're in. I'm very lucky to be doing what I do. Started my career in 1996. Was in the service for a while, got out, got my college degree, and started as a farmer's agent, actually. And then where I led my current life and profession is back in 2008 when the Great Recession hit. And like every business owner, any entrepreneur, any startup, or anything like that, you wear all the hats and you give hats away as you go and you're hired and everything else. One hat I kept was working with business owners and really managing their risk and what they needed to be able to handle all their different risk profiles they had. And then unfortunately, the financial risk was something I missed. And, most clients today, or most business owners, they know accelerated depreciation very well. Obviously, I think the farming community probably knows better than anybody.
Right.
But, sometimes, you're taking your financing equipment, just hoping next year's going to be better than this year. And that's unfortunately what I saw, and specifically my subcontractors, my general contractors. They got caught up in that housing debacle, and unfortunately, a lot of them got auctioned off. And then I was exposed to a gentleman that had 6 or 7 of these kind of plans we're going to talk about today, and he pivoted in a way that he was able to excel and exceed in those downturns. So that's where I thought, man, our risk takers, our business owners out here, our farmers, our dairymen, the risk takers, this is a tool they need to be aware of, and at least do their due diligence to see if it's a good tool for them. And that's what we've been doing since 2008. Now we have 800 plans around the country, and we have about 120 agents representing our products. And we have a variety of products and how this is leveraged for business owners of all types of industries. I'm excited to be on your show here to really talk to the farmers, your listeners, because we are really busy in that space this year, mostly due to traditional insurances and the rates increases they're seeing, and how this works. So that's how I got started, and that's my background.
I love that. And my job today, I think, is we're just going to try and make this a sexy episode, even though most people don't think of insurance as being something sexy and exciting.
No.
But you're right. Here in Iowa, just for my direct knowledge, we've had a lot of traditional insurers pull out of the area. We had the derecho in 2020. We've had multiple hail events. It just feels like whether you're a homeowner, a business owner, or a farm owner, that we've seen premiums climb, and we've seen a lot less options to shop premiums.
Absolutely. And you know what's crazy too is, State Farm this past week got downgraded to a B.
Ooh.
Which, I believe State Farm's headquartered in Iowa. But that's a big deal. That's probably one of our strongest insurance companies in the country. So I think what that tells you is that's not going to go anywhere anytime soon. The code we're talking about, what gives our clients the ability to, if they're going to self-insure risk, and if they can't find risk, to be able to, they can't find the right insurance to cover their risk, then they're just self-insuring it themselves. So back in 1986, Congress got together and passed it was an 86 Tax Reform Act, actually, that they introduced the 831B tax code. And what that did was create an incentive on a tax-deferred basis. So if you got this risk and you can't buy traditional insurance with it, or it's too darn expensive, or there's too many exclusions or whatever, then you know what? We're going to allow you to own your own insurance company. And that's essentially what an 831B is. We are an 831B administrator. It's like owning your own retirement plan, right? It's called a 401k. That's just part of the tax code. So the 831B allows you to put so much money away. Back in 1986, when it first came out, it was $1.2 million. Interestingly enough, two things that, first off, it was crop insurance that was driving that bus back in 86. Okay. Private sectors were getting out of it. The government wasn't obviously the backstop today like crop insurance is today by the federal government, no different than FEMA and everything else out there, terrorism. But today, back then it wasn't happening. So Congress got together. It was really affecting farm mutuals very heavily. Farm mutuals have a lot of these types of plans. So that's really where that code got started. But then also the environment where they were in at the time, very similar to what's going on today. If you look back, it's almost eerily similar, right? High interest rates. Now you add in, inflation that we're having. A lot of the reasons insurance carriers are getting out of space is they just can't keep up with inflation on replacement costs of commercial buildings, farm buildings, equipment. All of those things have swung up so fast in replacement cost that it's putting a real burden on their rating because they really are they're not collecting enough premium for what they're insuring. And that's the stress. So one way to handle that is just get out of the market. And you're seeing that a lot. So, when you have these types of scenarios where you have high interest rate, inflation going on, not only local banks are stressed, but you're going to have insurance companies stressed too. And I will tell you, the fact that State Farm got downgraded to a B this year, this past week was shocking to me. And that I don't know what that spells for undertows going forward, but it's not a good thing for the consumer, I can assure you. They're going to have to keep limiting coverages or excluding, and they just announced 72,000 commercial policies are non-renewing in California. So anyway, very similar. You go fast forward today. You can put up to $2.8 million into these things. There has to be a 4-part test. We're the administrator, so we make sure. So one of the things I talk to clients about a lot, Tanner, is funded liabilities, risk financing, right? How do you risk finance something? And typically you would say, hey, I'm going to risk finance it through an insurance company. I'm going to pay a premium. I'm going to get a policy. I'm going to transfer my risk for the fire of my buildings, loss of stock, all that stuff, right? So I'm transferring that risk. And then there's things that you cannot transfer for because there's either not an insurance carrier that will take it, or it's this exposure that may be unique to you that you're on the hook for. And then how do you want to risk finance that? And the way I explain it to business owners and farmers and stuff is, do you want to use after-tax money to do it or pre-tax money? The pre-tax, you have to elect under 831B to make that happen. We're going to make sure, as your administrator, no different than a 401k administrator, that we adhere to that tax code. And that's what our job is. And that's really what we do today with a lot of clients all over the country.
So SRA is an administrator
of the 831B plans.
Okay.
No different than the 401k administrator is as well. So we stay in our lanes. We make sure that our clients adhere to the rules and regulations, and we go forward on that. And I think we've done a really good job. We're the largest manager of 831B plans in the country. We headquartered in Boise, Idaho. And like I said, I tell people all the time, we're a 16-year overnight success story, but nevertheless, and I should also mention COVID, unfortunately, helped in our concept.
Oh, sure. Yep.
Yeah. Because when we talk to business owners today, it's like anybody that had relied on PPP to keep their doors open or anything from the government, ERC or whatever, what's going to happen next time? Do you really want to, first off, are we relying on the government? And should we be relying on the government? And if this code allows you to put away tax-deferred money that you would have just gave the government anyway, and now you're able to put it into a vehicle like an 831B, not only is it good risk management, it's just good business.
Okay, let's break this down because you did what I wanted you to do. We've hooked them. We've hooked the listeners, and I think one of the things that you might have hooked them with is self-insure as a phrase. But first of all, 831B. it's what you're calling these plans. That's a tax code. What's the 831B?
It's literally where you find it in the tax code. No
Okay.
different than if you were to look up 401k.
Okay, so it's a fund, and
It's a law. It's a tax law passed by Congress.
Okay, good.
831B.
And we are able to utilize 831Bs up to a $2.8 million max funding amount
Per year.
per year. So what happens after a year? Say we've got the ability to fund this $2.8 million. We can do it again next year.
Yeah, I mean, there's rules to that. So that's the most of our clients don't qualify because you have to have actuarials, and that, again, as an administrator, we're doing all that.
Yep.
But the box is an insurance company, right? It's got to look and feel like an insurance company. So it is a C corp.
Okay.
It's going to have its own tax returns. It's going to be shareholders. A lot of times, it's the owners of the operations, or it's the operations company itself that owns the C corp. So to your point, you would just keep funding it, right? Or the premium stays in there. As long as the premium stays inside that plan, it's not being taxed. Only thing that is being taxed is a realized investment income. So if you sit in a money market account and you got $1 million and you got a 5% money, you're going to get taxed on $50,000 at the corporate rate.
On the interest.
That's the only thing it's going to get taxed on. The premium itself will stay tax deferred. So you just let it build up. No different than what insurance companies do.
Yep.
They want to build surplus, right? And this allows you to take on more risk. This allows you to build up for, if you want to self-insure your farm buildings. And I believe me, I have clients doing that, especially in the Midwest. Or you want to carve out you want to just take health coverage on yourself. I would say, Tanner, everything that's going in the Midwest in your area is what we're dealing with is health coverage. Health coverage has gotten so darn expensive. And the co-insurance deductibles you're on the hook for anyway. It almost makes it to where a lot of farmers and dairymen and ranchers are just saying, hey, I'll self-insure for health coverage myself. But the problem with that, they're just going to rely on after-tax dollars to do that. I think we make it a more appealing and more the ability to take that risk on because you're deferring and you're able to now have a whole dollar setting in there to handle that risk more effectively and efficiently than an after-tax dollar.
So for the most part, the self-insurance is scary. At least it would be to me, because I'm thinking of, all right, I set off year one, I'm going to put the equivalent of my normal premiums, or maybe a little bit more than my normal premiums aside. It's not $2.8 million. Maybe I've got $150,000 worth of premiums annually. And I set that aside, and I have a loss first year. Do I only get to draw out the $150,000 and I got to out of pocket the rest, or how's that work?
That's a good question. And it really depends on how we're pooled and if we get a stop loss carry in the back room. And so this is when, to your point, this is when we're going to get down in the weeds of it. But the idea is, and I would tell clients, like, this is a 4 or 5 year strategy and there'll be some risk involved. There is no risk-free adventure here, right? I mean, you're getting the advantages of tax-free to be able to build this up, but don't kid yourself. There's absolute risk in doing it. But for the right client and for the right appetite, you also may just want to say, listen, I'm going to do baby steps on this. I'm going to keep my traditional insurance. I'm going to keep, maybe you got loans. You're going to have to keep the A-rated carriers on this stuff anyway. But if you can carve out some exposures or take a higher deductible or take a higher co-insurance, you can start to fund for these underlying exposures you have, because you do have first dollar loss there. And unfortunately, a lot of it's becoming fairly significant, right? I mean, when you got a 20% co-insurance on a $5 million dairy barn, you're on the hook for the first $1 million of that thing, to get it rebuilt. So,
right.
Those are things that you can start to fund for. And then as you fund, like every other insurance company, as you grow your surplus, you're able to take on more risk. And then it's just a matter of every year we'd have a consultation with it and say, okay, what additional risk do you want to do this year? Or do you want to hold pat? And maybe, this is a cycle we're in right now in insurance anyway, but it could last up to 10 years. It lasted about 10 years last time. And so until that starts to straighten back out, these give you the strategies at least, because you're stuck with this risk. I mean, you're stuck with the first dollar risk. You're stuck with all these things that you're going to have to be on the hook for anyway. And you just want to make it more manageable for you. And at the idea that down the road, maybe you do become self-insured on all your properties, if that's your goal. I mean, we all have clients like that, they don't like banks. They eventually start to pay all their stuff off. And, now they don't want to insure it, but they don't want to take the risk of not insuring it either. They don't want to pay the premiums for it. And then true, we're running into a lot of clients that just simply aren't going to turn the claims in because they know if they do, their neighbor down the road got canceled for it. Or the rates went so high up, they're just paying it over the next 3 years anyway. So why am I submitting the claim? So
I actually just talked to somebody that said the same thing. They're not turning in a claim from a fire because the anticipated jump in premium is about what they're going to pay out of pocket to do the repairs. I find this interesting. I've got so many questions. I'm going to do my best to stay somewhat organized. You mentioned we could group, or you can or you can't group together when I asked what happens if we have a loss in year one. Are microcaptives for me and only my operation, or can I group like operations together?
We pull groups all the time. What's one of the qualifications is you have to have a risk distribution. And what I meant by whether you can or can't is really, we call them exposure units, the amount of exposure units. If I got a large enterprise farming, and if their distribution is pooled enough, not only from amount of exposure units, meaning tractors, barns, buildings, then do we have a spread of geographical as well? Mm-hmm. Then we can potentially keep them within their own pool. So they're basically insuring their own risk. But as long as we have a lot of exposure units, we can justify that. If we were using a smaller farmer, then we would pool risk together. What's funny is in every insurance company that has farmers in it, all started what I just described. They all got together and said, hey, we'll share in each other's risk. This is 150 years ago, 120 years ago.
Right.
I mean, Farmers Insurance started out of Orange County in Southern California with two farmers getting together because they couldn't find farm liability to get on the public roads. And there was rules and regulations put in place by the state that said you had to have liability on if you're going to drive your tractors on the road.
California
and nobody was offering
rules?
that insurance.
No way.
So but it's State Farm, Farm Bureau. What's funny about Allstate? Allstate was a Sears and Roebuck's warranty company. When you look back at the history of how these companies started, a lot of them started as co-ops. Your mutuals, your farm mutuals are nothing but co-ops, and they own a lot of these 831Bs inside. They're all sharing each other's risk, right? So we could absolutely share up risk. We can do it in a blind pool or a controlled pool. And what I mean by a controlled pool is these are people that got together and said, hey, we'll all share in each other's risk. We've got to have at least 12 different independent operating companies to make that work under a safe harbor rule. Or we can form a blind pool where, like our pools with our traditional business owners we work with, our pools average between 400 and 800 participants. So there are going to be some shared risk in those pools. But, if you're going to be an insurance company, remember I told you the box has to look and feel like an insurance company. One of the biggest things you have to be able to show is how are you leveraging the law of large numbers? Meaning not everybody's going to have a claim at the same time. Not everybody is going to be filing the claim, in a year. There's going to be a lot of times when companies don't have claims. And that's that distribution of risk that you have to have. And as administrator, I think we probably do that better than anybody because we understand insurance and we understand the rules to engagement on this thing. And it gets back to your earlier conversation about risk. You are going to, in those situations, you are going to share in other people's potential losses. How we do that and how we manage that is up to us. And those are things we can dive in individually with clients because it's important to us that they understand that.
Right. And I do think that there's a lot of our listeners that feel like self-insurance to an extent is their goal because every one of our listeners knows a couple of producers that don't take crop insurance. And whether it's due to I'm not taking government subsidies or it's due to they think they got lucky for a couple of years and feel they've saved enough money to insure themselves. Or maybe what we don't realize is they've been working with microcaptive plans.
We do a lot of crop insurance, especially if you're going to buy down to 60%. 60% pays your real cost, 60% of the crop being grown. After that, the other, if you're at 80%, you're out money. You've lost money that year, even if you bought crop insurance. And a lot of people are buying down to 60% just to be able to afford when they do buy it. So we cover the gap on that. That's a great example of deductible reimbursement where we're going to cover the next dollars. And again, to your point, obviously the first 1 or 2, 3 years, it'd be painful if it hit. But if you get through 3 or 4 years and now you built up all these reserves and surpluses in there and you did get hit that year, you're going to be made whole, not just 60% of the value of your crop, but the entire value of your crop. And that keeps you living. The other 40% is what you live on, right? So it's where you get your groceries and pay your house payments. And so those are just great risk management strategies that, unfortunately, in our past history, especially in the farming world, that they just weren't aware of. And again, I'm so glad to be on your show, because this is about awareness and education. This is all this, and it's a tool. Don't it's not a silver bullet, and I think we've described that pretty well. That there is risk in these things, but for the right client that has the risk tolerance, it's a great tool.
Yeah, because you were saying before we hit record that this can be just for one peril, for one risk, or it could be set up for multiple different perils.
Yeah, it's really what the client wants. What's keeping them up at night? What's we're dealing with a lot of things in crop and we got seed growers out here in Idaho, potato seed growers, and that's probably one of the things. Well, they have to, there's a warranty, there's a perceived warranty on those seeds that they're going to produce the way they are. And if you have a big buyer, you need to keep them happy. So sometimes you eat those seeds, right? Because the yield wasn't what you thought it was going to be, and somehow you got blamed for it. It happens. And then we talk about a warranty risk. We talk about all these other things because we handle a lot of warranties under these plans. I work with really large farm equipment manufacturers that sell their own warranty plans, and they have these types of plans. You go buy a Ford or Chevy truck today or whatever, and the F&I guy in the back room is going to push hard for you to buy a service contract. That dealership has its own 831B plan. They're going to charge you those dollars, and they're going to scrape them out and put them in this 831B plan. So when you have a warranty claim 3 years from now, they're using that money to handle that claim. So these are things that are going on out in the back rooms that the consumers and unfortunately a lot of business owners don't know about. But these are tools that can, at the right time, can make the difference whether or not you live through a situation or not financially. And that's why I'm very passionate about this thing, because I know the difference we made, what we could have made in 08, 09 with clients. And I also know the difference we made during COVID. We were the first ones to respond. Our clients had claims, especially if you're in the hospitality, medical community, dentist, restaurants. We were able to respond to that much more broader and simpler, because in traditional insurance companies weren't going to respond when you were forced to shut down, right? That's why PPP and all the other government programs came out. And today, having that conversation, Tanner, like, hey, Mr. Business Owner, hey, farmer, if you were relying on the government for those things, what's going to happen down the road? Should we be relying on the government? And if you don't have to be relying on the government, wouldn't you look at an 831B to be able to manage that going forward to where you have your own PPP plan? And that's really where we can start connecting dots with business owners and owners and farmers, because this is not, I don't want it to sound like a rocket ship, Tanner, but unfortunately it's insurance and it's a nuisance. Insurance is perceived as a nuisance. I get it. But at the same time, though, I think everybody out there that owns an operation of a successful enterprise needs to look at risk management, and they need to look at strategies like this, in my opinion.
So for me, where this is hitting home, right, is we know that the options almost feel endless for what risk you can protect and mitigate or transfer, like you used in your early terminology. And that's why it can feel like a rocket ship, because there's so much risk in an operation. But why are we using an 831B plan instead of just putting this in a money market account at the bank?
Yeah. So great question. You pay taxes on the year you incur the income, right? So this is why the code exists. You can't just say, hey, I'm going to retain this risk. I'm taking this dollar and parking it off the side. IRS says, hey, guys, that's not a deduction. Self-insurance is not a deduction. So that's why the Congress back in 86 formed this tax code. They recognized this issue, and they said, okay, fine. We'll put a tax code in there saying that, hey, if they're going to retain risk, they can own their own insurance company. And as long as they meet certain parameters, they can elect an 831B. So the 831B is really for small insurance companies. Large insurance companies will have a lot of Bs. So there's an 831A and 831B. An 831A, think of those as a traditional insurance company. Anybody you hear out there, they're a C Corp. They have rules and regulations of taxes. But even under the 831A arrangement, a lot of these companies will have a lot of 831Bs, because 831A gets taxed on all their premiums, all their realized profits on an annual basis. Again, they're going to carve out risk inside there that, if they have a lot of protection class 9s, for example, if you're in a rural area and you don't got great fire response and you got a protection class 9, they might have a lot of exposure for certain counties or certain states. They're going to want to put a B in there because instead of being a taxable income, now they can put money into those Bs and start building that up on a tax deferred basis, and they can handle that risk more effectively. So these are large companies doing this. Okay.
Right.
And by the way, Monsanto, anybody you're dealing with, Case, John, all those guys have a ton of these own insurance companies.
Right.
Most of them all offshore, truthfully. We don't go offshore. There's 34 states now. Iowa just recently passed legislation to own insurance companies like these inside their state. I think it's the last state to come on board, actually. Texas was prior to that. But now, when I first started this back in 2008, there was 8. There's now 34. And so, there's a huge explosion going on out there. And, unfortunately, a lot of people don't know about it. The CPA community, a lot of your CPAs, and especially in rural states, God bless them, they're just trying to understand what happened in 2017, right? I mean, for the most part, this is a tax code that a lot of them hadn't even heard of yet. And again, it is what it is. But we are the educator. And again, that's why I appreciate being on your show again. I can't say that enough. So.
And thank you for being here, because I'm learning, and I know our listeners are learning too, and it's only going to scratch the surface. So be ready for emails and phone calls. But I'm about ready to text my CPA and be like, how come we didn't talk about this? Because I see where this can be used, but like my 401k, I know that that's something I can pull out for retirement, and it's going to have penalties if I pull it out early or pull it out for something else. I know I've got a college savings account for my daughters. Same thing. If they don't go and use it for higher education or training or certification, that it gets pulled out, it's penalized. Do we have to identify what risk this is for when we put it in?
Yeah, but here's the cool thing. That risk goes away because you got 12-month policies. Risk doesn't stay there forever. So again, this is insurance. So you got to act in, one of the tests that is acting in principle is insurance. You don't write an insurance policy and have it enforced forever. So we as an administrator are going to have, if you say, hey guys, I'm going to, through actuarials, through a methodology we use to determine what premium you can put in. By the way, we always give you the ceiling.
Sure.
Anything below the ceiling we're perfectly good with. So we'll give you your max. Like most clients can't max at the 2.8.
Right,
you got to be very, very large gross revenue to get there. But nevertheless, we'll come back with the number. That premium goes in to the 831B plan. It doesn't get taxed. Again, the only thing it's going to get taxed on is realized investment income, money market account, all that stuff, the gains you made. But the premium there stays tax deferred as long as it's inside that vehicle. And as what happens is like, let's say down the road, I get this question asked a lot. Well, what if I sell the farm? What if I don't have the exposure anymore? What if I don't have, and we as administrators say, listen, we'll allow you to keep it open up to 3 years in case you buy another company, you do something else, and now there's no new risks that we can fund. But after 3 years, if you don't fund the risk for it, we're going to shut it. We're going to ask you to shut it down. Here's the nice thing is it comes out of capital gains. It's not taxes or ordinary income. What you just brought up, all those other vehicles, you're just kicking the can down the road and you're deferring the taxes. But in our program, you're deferring the taxes, but you're also changing the outcome to a capital gain situation or qualified dividend situation versus an ordinary income rate. And I think that's something to be aware of, because I do think there's some advantages there as well.
So if we put it in year one, identifying this as it's going to mitigate my hail policy. We go 12 months, have no claim, and next year we're going to fund it again, but we look at matching a risk with, I'm just going to, for lack of better terms, fire on my homestead or whatever we're transferring. We can change that year to year. It can be hail, crop insurance.
Well, I mean, what do you do with your insurance today? You can change it from year to year too with your own insurance program, right? Hey, I'm not going to insure that tractor for full coverage this year. I've paid it off. I don't, it's not worth, if something happened to it. Hey, the barn, well, that's what I was saying earlier. I mean, unfortunately, a lot of the properties have gone up so darn much in expense right now in replacement. It's putting a lot of stress on insurance right now. So then do you want to just determine the value of the building and say, okay, hey guys, and I actually have this going on in Missouri right now. It's worth $35 million. The guy says, hey, I just want to insure for 10, and you can do that.
Sure.
So there's all sorts of things, but you as a consumer every year are deciding what you're going to be covering.
That's
and,
fair.
and we'll give you guidance and consultant. We'll consult. I mean, like I said, we have good risk manager strategies in our company that will guide and consult. But at the end of the day, the client's the client. I mean,
right. But you mentioned 4 to 5 year plan. We don't want to transfer all of our risk into this type of a style year one, because a catastrophic loss would be more than catastrophic, if there's a word that describes that. But you're right. If I wanted to put in 2 tractors the first year, and then the second year I add the combine, and then I may pull those back out and insure the rest of my fleet of equipment, whatever it looks like, it's nice to know that we can change that on each end.
This profiles change from year to year, Tanner. I mean,
Yep.
I have the risk this year, I don't have the risk next year. I mean, who knows,
So how do I file a claim?
So you file a claim through us, and we have our own adjudication process. We have our own, and we would hire an independent if we don't think we can make a clear distinction, then we'd hire an independent adjuster in your local area, no different than mutual insurance would, anybody else out there would. And that's we as the admin, that's our responsibility to you. Especially if you're in a blind pool. What's kind of cool about, and I say about blind pools, is when you're sharing in risk, it puts us in a fiduciary to everybody else in those pools. And so, the integrity of the claim has to be handled as a fiduciary situation. And that's where we as an administrator have a job to not only to the client, but also to all of our clients that are sharing in that risk, that this is a legitimate claim. And we do have exclusions. We do, we write a 4-part of an insurance policy, no different than set by the Insurance Standards Office, ISO, that every state uses in the union to determine how an insurance policy is to be written. And we do that as well. And so that's a great question, but it's an online form you fill out, no different than your traditional insurance would go through that process. No, really, literally no different.
My mind's racing with all of the options. I mean, this is the first time I'm looking down at the outline as to what is going to be, options. I mean, you've got listed here supply chain interruptions, cyber security attacks, death loss, business disruptions, brand damage, political risk, disputes, warranties. I mean, there are so many things that we're not even talking about. I'm thinking about physical assets, and there's other things that can be insured. I know that when you continue to sit and have conversations around what is a risk to a farm anymore these days, we could peel off something, like you said, that keeps us up at night.
100%. One thing that happened a couple of years ago was avian bird flu came through, and the insurance industries has pulled. I've seen some of the livestock policies come back for death loss, and it's like this isn't even worth the paper it's written on. And then they're all like, I don't think I'd even turn it in. And it's like, well, why would you even do that? And so, I mean, we're insuring $16 million Angus herds now, self-insured on death loss. They're not going to cover disease anyway. They're going to cover lightning, and if your snow load on your overhang is too heavy and it collapses and kills a bunch of cows, it will cover it. But even it limits to $1,000 a cow. I see. So what are you buying? And so we actually started offering death loss a couple of years ago when avian bird flu, and it just put a lot of stress on the insurance industry that's offering that coverage. But the other thing I think you bring up too is, the world's gotten complicated, man. I mean, you look back in 1986, no cell phones, none of this. We weren't doing podcasts. You look at the things how much more complicated the world's gotten, and truthfully, the traditional insurance carriers are still insuring as if it's still 1986. They've not added a lot of additional coverages on there based on where we're at today. Supply chain risk today, I think, is huge. Brand protection.
Well, sorry to hit on this. Supply chain, I mean, we just had a bridge get hit by a container ship.
Yeah. Oh, yeah. And then the business interruption policies were, unfortunately, East Palestine and Ohio, right? Well, anyway, where they got shut, they had to evacuate the city for 7 days. Well, all those businesses were shut down. And again, it's no different than COVID. The rent didn't go away. You had to keep paying your employees to keep them there. But meanwhile, you had no income coming in because you weren't open. Those are true business interruption policies that are not going to be covered in our traditional insurance.
But we have we have to identify this, right? I can't just all of a sudden show up and say that, yeah, this was identified for my equipment and machinery, but I'm going to also tack on a business interruption rider. I'm making terms up because I'm not, educated.
Well, good example is a key piece of farm equipment that's broke down, and now you got to pivot to go rent another piece of equipment.
My in-laws discovered this spring that the PTO went out on a tractor, and they didn't realize that the PTO housing is discontinued. So it is literally being custom built, the cast that the PTO goes into, and that's going to take twice as long.
Oh yeah, and time is money.
Boy. Okay, so we know that it has to be identified, but how do I know if I qualify? Are there rules for qualification, or can anybody sign up for this?
Well, you got to have an operating company, and there's got to be risk.
Yep.
I would say those are the two qualifying elements. And unfortunately, risk is not a problem in today's world, as I think we've outlined. That being said, on top of all that, it does come down to dollars and cents. There's fees involved. Obviously, that's how we make our living. And so we're very candid with the clients. I mean, if you're not a fit for us, we will tell you. And when does that parallel cross, and the nice thing is our plan. So I'll just go through the dollars and cents of it real quick, Tanner, if you want. It's $6,000 to form one of these plans, and it's $6,000 to maintain it. And that's every year. There has to be a tax return done, the domicile fee once they're pound of flesh. And then there's also premium taxes involved wherever we domicile. That's why the states want you to come into their state, because they charge premium taxes. It's another tax that the general public doesn't have to know about, right? But it is a tax. But they're doing it for revenue. No different than why so many Fortune 500 companies are in Bermuda, Cayman, Turks and Caicos with their insurance companies, because they're paying taxes to those countries, and obviously it's much more favorable than being taxed in a state. Anyway, but no, I think the qualification of it is, it's case by case. We're happy to vet it out with every client out there. Like I have 120 advisors around the country now that represent our products. That if I can't have my internal office handle it, we would put it out and just have the conversation. And again, I can't emphasize enough where, the world's changed, man. It's gotten complicated. The risk management of any business today has to be on the forefront, because you can kill it. You can have a great yield on your crop. You can just it, but okay, let's talk about yields on crops. In Idaho this past year, onion farmers killed it. Made just did very well. But the last 3 years they got killed. They were lucky to break even a lot of times. And again, I tell business owners all the time, if you're in a situation where you can just take a little bit off the top in those good years and park it off to the side, not only is it good risk management, it's just good business.
But you got to fund it every year?
No, thank you no, because that business cycles happen. So the most it's going to cost is $6,000 that year to maintain it. And if your reserves are sitting in there and they're sitting in a money market account, it will become a frictional cost to maintain the account. There's some additional fees if you fund that I didn't mention, but when it comes to maintaining of the account, it's very manageable. It's one of the things I didn't like about it when I first saw it in 08, 09, 2010. Managers were charging $40,000, $50,000 regardless. And I'm like, well, this doesn't make any sense. They're not in a position to fund the risk. What additional paperwork are you doing to justify those kind of fees? And it's just a money grab. But we made it to where I did it to where my clients are the small to middle market business owners, the mom and pops, the real risk takers that can't really weather storms, unfortunately, when they get hit with an unexpected expense. And we priced our product in a way so more clients can qualify under our program.
So as far as that goes, if we do have a good year and we have excess cash, this is a potential tax maneuver that allows us to take a deduction and contribute. But if next year's tight, I don't have to contribute. And as long as there is still risk.
What can you afford on your insurance program that year? I mean, that's literally the question that's going to be asked of you, Tanner.
But as long as I still have the business and I still have risk, this fund can stay in place.
Absolutely.
So if I go back to that qualifying question, are any of our listeners too little risk or too much?
That question used to be answered a lot easier. I would say if you're not in a position to over a 5-year period of time to at least $80,000 a year over over at least 3 of those years, based on fees. It may not be as sexy. And all I'm doing is attributing to whether or not you would have just been better off paying your taxes or doing our program.
Yep.
And assuming no growth on that money and, like a 20% claims ratio. We have a pro forma we send out to our clients, and they can run those numbers. We don't do it for them, but we obviously give them the outlay to it, and they can do the math themselves. We're not here to alleviate people's tax liabilities at all. What we're here is to alleviate what's keeping them up at night, and that's really the self-insuring risk that they're finding themselves in.
So a couple of our listeners are going to totally understand my next question. If we've got a listener that is prone to fire or has had multiple claims over a period of time, does it get to a point to where they're too risky for something like this to make sense?
I don't think so. I mean, this is this true backstop. This may be the only way. This may be the only vehicle you can turn to. So I would say no, absolutely not. The other thing about the fire is I mean, we can build a program like, hey, what's your average fire claim? Okay, we're going to go right above that. You got first dollar loss again on that. I mean, we don't need to. It's your okay. You own the insurance company. We're going to give you consulting what risk it's going to have, and it's designed to solve your problems. So it puts it in your control, in your hands. How do you want to craft? What are you trying to cover for, and how do we get there?
So as far as what's going to happen next, you're going to hear a voice from podcast heaven. You won't be able to see him, but we're going to get you a question.
Well, I came in a little late, so I have just a general insurance question. You just made me think of it when you talked about fire, right? So I've hit 4 deer now with this truck that I have. And the other day, a deer ran in the side of my truck.
It hit you.
It hit me in the side door, and I got a 4-door truck. It's in the rear door of it, okay? So I call my insurance man, and I said, hey, Dan, I'm thinking of making a claim. Here's the deal. I went in. They want $6,000. It's a $12,000 truck. I have comprehensive. Should we fix it? Okay? And I said, but what I want to know is my insurance going to go up? This is act of God or whatever they call it, okay? And he says, well, I don't know. How can you not know?
It should not go up because it's a comprehensive claim. Only collision, which means the vehicle is moving at the time of the accident and it was your fault. That's collision. Comprehensive is no different than a rock hitting your windshield. In this case, it's a deer.
Yeah.
So to me, your rate wouldn't go up. That doesn't mean it won't go up, but it shouldn't go up because of that underwriting.
So I asked, I said, well, somebody in your company knows if it'll go up. Well, it might go up a little bit. Well, who knows? And he's like, well, nobody knows. I'm like, what do you mean nobody knows? Somebody is eventually going to raise my rate on this damn policy. Tell me who the hell that is so we can do a trial of what this looks like. Pretend you put in a claim and tell me what my insurance looks like. Nobody can give me an answer. Same thing happened when we were pregnant with our first kid. I said, okay, we have 2 insurance companies. I have an insurance company. My wife has an insurance company. So which one's better and who gets first dibs and who takes second position and whatever? Oh, we can't tell you that. We can tell you after you have the kid, but we can't tell you to prep before you have the kid.
I know.
It's so frustrating.
Very fun. Yeah, I know. The consumers, unfortunately, a lot of times are at the mercy of the insurance company. And, what your agent's trying to do is just kind of hedge against himself because he doesn't know truly. I mean, I would tell you, I would feel very confident that says, hey, listen, what's going to happen is they're going to look at your underwriting and say, hey, man, you got 5 comp claims. That's a problem. And do you really want to be insuring this full coverage anymore, even when you do have a full rate down the road on a $12,000 vehicle? Mm-hmm. I mean, that's what's going to come to. I mean, rates are going up across the board.
Yep.
And they will continue to. And I think that's what your agent's probably worried about, that he says it may not be attributable to this particular claim, but he knows rates are coming up regardless.
Okay, Dave did make a point here that made me think about this. Can we use an 831B for health insurance?
We do for big companies that are self-funding health insurance. Oh. So this is like the guys that are doing with the stop loss carriers, and these guys have got 100 employees or more. A lot of them are going to self-funded healthcare plans. I mean, there's stop losses in the back. They're meaning that if they have a runaway claim, they might be on the first hook for a life for $250,000. And then there's, not to get too complicated, but there's corridors and all sorts of stuff that they deal with in these. So we build plans specifically for certain risks within their healthcare plans to again, if you're going to take this risk, do you want to use pre-tax or after-tax? And
Yep.
if it's after-tax, then go do what you got to do. If it's pre-tax, then we're here to solve that problem.
So what's the catch, right? We're 45 minutes into this. What's the catch? We know the catch of regular insurance is I could pay my premiums and never take a claim.
Yeah.
But at least this, it sounds like I could still pull the money out. So what's the catch?
Here's the thing. This code's been abused. Shockingly. I don't know. I tell people, the Boston Tea Party was a real thing. People hate paying taxes. And they will go out of their way to pay taxes and take a lot of risks to do so. Unfortunately, this code was hijacked back in 08, 09, 2010 for estate tax purposes because the state taxes were so low. It was sold as an estate tax play versus a risk management tool. And I think the PATH Act in 2017 cleaned some of that up, but there still are some players out there that like to play games that the IRS doesn't like. And so they get the headlines. Getting back to the CPA community, I think the CPAs that are trying to be compliance public accountants, meaning that they're just trying to do your tax return and not really do tax planning with you. Tax planning is not telling you what you owe. That's not tax planning. I call that the battle's been fought, and now they're just body counters.
That's tax reporting.
Yeah, I love it when a CPA says, "I'm going to go do some tax planning." You're just going to tell me what I pay, what I need to pay. What can you help me avoid what I'm going to have to pay? Mm-hmm. Anyway, I digress. So that's the challenge. I mean, for a lot of farmers, a lot of business owners. I mean, everybody's busy. I mean, everybody's trying to do what they got to do, right? And so they rely heavily on the CPA community to give them guidance in areas that, truthfully, they don't do a lot of guidance. I mean, they don't do a lot of tax planning with their business owners. Their big tax plan is buy more stuff, finance it, take a full accelerated depreciation, and this bet next year is going to be better than this year. Why? Because now you got debt to carry forward. That's a form of insanity, right? I mean, you can't keep betting every year is going to be better than this year. We know that's not the case in the farming world. You can have 3 or 4 bad years and have one, and okay, I'm okay now. I can survive the next 4, but I'm going to lose money, right? I mean, so that's the challenge. And so from the catch standpoint, that's the challenge. That's our challenge to bring business owners and CPAs to the community that says, hey guys, this is we got a great lobby group. We're getting some traction with Congress right now. This is the next PPP plan. We can't do what we did. We cannot be given $6 trillion and make believe money up. We still don't know all the ramifications that's going to do to us in the future. But what's going to happen the next time? Yep. And this is a legitimate code that was passed, ironically, for crop. One of the things that was going on was crop insurance, amongst other things, that farmers were self-insuring crop insurance. I would argue a lot of farmers are still self-insuring crop insurance today. They're just not aware of this tax code.
Well, I would agree. And like I said, it's the people that potentially decided I'm not going to take it this year, and it worked. Mm-hmm. So, I'm not going to take it next year because I just saved my premium last year. And all of a sudden, they're 4 years into this, and they're not going to take crop insurance because they just saved in their mind.
Yeah, they're rolling the dice.
Yeah. It's not protected. They're not transferring any risk. They are literally self-insured.
Yeah.
Okay, so I'm interested, which means we at least have one other listener interested. How does this start? What are the steps to figuring this out specifically for me?
Yeah, so we own the website called 831b.com. I encourage listeners and you.
How well does that get searched? Because who looks up without even knowing what an 831b plan is? Sorry, off the rails. Go ahead, continue. You own 831b.
Yeah, we love the domain because obviously it's I have a great marketing person that negotiated with a company in China to get that domain, but that's a whole other story. But no, we want people to find it specifically, right? So 831b.com. On there's an educational, do I qualify? All that stuff's on there. You can reach me at van@831b.com. I will happy to turn you over to, if I can take your call and or emails. I've got a very strong sales team. And then, like I said, I got a distribution around the country with the other advisors. And these advisors are typically CPAs, property casualty agents, attorneys, and financial planners. But no, I and that's where it starts. And it's just the question, right? And a lot of your listeners, they all have pain points. I deal with, especially in the farming community. I mean, And the risk, I mean, you guys are not risk adverse, obviously. You wouldn't be a farmer, right? So I think it's a great tool for clients. You guys are already predisposed of taking the risk and self-insuring yourself anyway, truthfully. You're always betting on yourself.
Right.
And so that's where it starts. It's just due diligence, reach out to us to the emails. Obviously, there's a contact us page on the 831b.com. And then, start the process. I think start to due diligence, understand this thing. And again, it's not a silver bullet. There's obviously some inherent risk from a risk pooling standpoint. But at the same time, though, I just think business owners and risk takers if we can mitigate risk. One of the things that I meant to bring up, the best compliment I get as a risk manager is, Van, I just sleep easier at night knowing I've done your plan. And truthfully, there can never be something better from my profession than a business owner, a risk taker, say that to me. And it's said quite often to us throughout the year, especially at the end of the year, when underwriting went really well. We don't have a lot of claims, and now they have realized profit in there, and it's a good day.
I was going to ask you what your why is, but you pretty much answered that. That if you can help people sleep better at night. But I want to go back to this because I think Dave's going to reach out to you to try and insure speeding tickets and getting hit by deer. And I know that doesn't fit the premium model, but can I fund this? How long? 2 questions. Start with the first one. How long does this take? I reached out to you, contact us form. How soon until I have something in place?
3 to 4 weeks.
Okay.
We got to form a company, right? A C corp. We got to have shareholders. We got a president, secretary, and we handle all that with the upfront cost of $6,000 formation. We get the legal documents put in place. We get the domicile put in, and we get the EIN number. So now we have an active company, and all that process during those 3 to 4 weeks, we're having underwriting questions. We're having, either via emails, phone interviews. What are we trying to accomplish? What are here's what we see in the industry. Here's what specifically you're farming, whatever you are farming, or dairy or ranching or whatever. And then, we start to build out policies. Obviously, we got a lot of policies on the shelf we can just pull off, and then we start talking about premiums. How much premiums? How do you want to pay it? Monthly, quarterly, annually? Do you want to wait to the end of the year to fund this thing or when the crop comes in or whatever? We're very flexible on that front. And so, that's the timeline, and every year there's conversations, right? I mean, this is not a set it and forget it kind of program. It's, there is going to be a level of involvement, obviously, but I think you become a better owner and a better steward of what you're doing when you do programs like this. Truthfully, it forces you to.
He's in my head. I was going to ask if you could do monthly or lump, or if I didn't know until the end of the year. So good on you for doing that. One other thing that I just circled on my paper is, can we do this for life insurance?
No.
Oh, really?
Yeah. A lot of our competitors do. And I think that's where the biting the apple twice. Because the thing about life insurance, you're using tax deferred proceeds to fund a life insurance, and the life insurance is paid out tax free. So in my opinion, that sounds too good to be true. And if people are promoting that is a tax-free way of getting, and I always make the joke, but it's true. Well, then you must plan to live forever, because I live by the 2 golden rules of death and taxes. And you're just telling me right now that I'm avoiding paying taxes. And I just think that just puts pressure on the program in a place that doesn't need to go, truthfully. I mean, it's good enough. It's good enough.
Is there any way to use this program, not knowing all the key points of it yet, because I come in a little late, but is there a way to use this program to, we talked about buying health or life insurance to then buy farmland,
right,
to start preparing to buy out brothers and sisters in an estate or something like that. Is there a way to use SRA for that?
There is, and we do a lot of family succession planning, because this is a great way to build up tax-deferred money, and then you can just... We do a lot of father and son transactions this way. Dad owns 50%, son owns 50%. They run this thing for 5 to 6 years. There's a lump sum of cash in there. They go to shut it down. His portion goes to his father. There's his lump sum of money. The company's already been used to paying a premium, and that's been a line item expense anyway. So, dad can even keep one going if he wanted to, or son can open up another one. And so we do a lot of those transitioning, and I think you bring up a great point. I mean, not to talk heavily about taxes, but I think that's the biggest challenge we have in our country is how do you make this transition work? Because every dollar you make, you have to pay taxes on it. And when dad gets it minus his basis or family member or relative or whatever, he's got to pay capital gains on it. And it becomes a double taxation issue, which makes it very, very, unfortunately, a lot of people just die with their farms, and because they never make that succession plan because it's too big of a hurdle to overcome.
Well, sometimes stepped up basis is their succession plan because their kids can sell it with tax free. So then they avoid one of the two in taxes and death. Well, they death and avoided taxes.
Yeah, to an extent.
That's true.
Yeah.
That's a good point. And I think I think unfortunately in that community that of the farmers and ranchers in Durham that's probably one of the only card they have to play, unfortunately. But I mean, they're asset heavy, cash poor a lot of times, right? So it is what it is. And so
I know, Van, we're going to drum up a bunch of questions from our audience, and I'm going to encourage them to email them to us or comment on our posts, and we're going to end up having you back because we can't cover all of this in an hour, and it'll be kind of fun, I think, when they contribute back running some scenarios. Obviously a scenario is not going to apply to everybody, but if a listener is willing to contribute that, we may get you back on for a part 2 later in the summer, so I appreciate that. At the end of every episode, I like to try and summarize what we talked about, but I want you to think about what we haven't covered. What question I missed that you can think about as we kind of go through this list before we wrap up. So we started off today, Dave, kind of a summary for you as well, talking about microcaptive insurance. Mm-hmm. And at the beginning of this, nobody knew. Very few of us knew what that even meant. And we learned very quickly that it's another tool that Congress put into place in 1986, right, Van?
Yep.
That is a way to manage and transfer risk.
It's about when you were born.
That's before me.
No.
Yeah. way to call that out. Thanks, boss. Yeah.
Young gun.
But it's a way of self-insurance. We do know that there's a $2.8 million max premium contribution annually. Very few of our listeners are even going to have to worry about that. But if they do, congrats, props to them. I think Van would love for you to call them. As far as that goes, it doesn't come without rules. We want to make sure that we understand that the box that we're putting these funds in has to resemble an insurance company. That's what we're doing. We are transferring risk of some kind, and it will be treated due to the regulations and rules in place as of that. There are advantages to doing this because it is a tax-deferred contribution. You do get taxed on any gains, like if you've invested in a mutual fund or a money market or something along those lines. The interest earned is taxed, but that's the advantage of doing it this way versus just creating your own savings account and having a rainy day fund. We can change what the risk is on a year-to-year basis, just like you can talk to your insurance agent and change what your policy looks like. You could insure for hail one year. You could insure equipment the next year. You could take pieces in, pieces out on an annual basis to be able to mitigate whatever's troubling you that season. Premiums can be paid monthly, quarterly, lump sum, not every year. If you've got a good year, you can fund. You can sit back in a year that's a little bit tighter and continue to manage your operation that way. A reminder that self-insurance, the savings account, the period pure self-insurance is not a deduction. We also know that once you have identified your risk, the managers like SRA are the ones that you file the claim through. They've got their own process. They're the ones that will do the appropriate steps for you as a part of managing the fund to make sure you fit within these rules and guidelines. We don't want to be one of those that falls into that category of abusing this system. A myriad of opportunities for risks that can be put through and mitigated through this process. Went through a long list of those, and I know that I missed those that are even potential options, and I'm excited for our listeners to tell us a little bit about that. We can do a blind pool. We can do a controlled pool. If we're going to do a controlled pool, we need more than 12 different entities. Correct, Van?
Unrelated
entities to be able to put that together. But ultimately, I'm glad that we did this interview because I learned a lot. I hope our listeners do too. And we also know that if you go to 831b.com, because now you know what an 831b is, you can get started. And we have a very clear process as to how SRA makes their money, which is great. Transparency is key for us.
So, picking up on what you're putting down, is this like an HSA but for non-health insurance?
Yeah, you're a smart guy, man. But that's exactly what it is. We say it quite often in presentations. It is an HSA for your operating company.
For operating. Perfect.
I love that. Well, we try to ask a question of all of our guests, something similar, a little bit of fun and off the beaten path. So once you answer the question, remind our listeners how they connect to you. But I want to know, what is the best food you've ever gotten and where did you get it?
Oh, man.
Something popped in your mind. You had something.
Well, yeah, I mean, hey, man, I'm going full carnivore right now. I don't know if you guys have tried that diet, man, but I'm digging it. I don't know if I can be able to do it long term, but, man, it feels pretty good right now. So I'm loving ribeyes. And we have Snake River beef here in Idaho, man. There is no better place than buying beef directly from a producer. So that right now has got top of mind. A ribeye steak is hard to beat.
It's a good answer.
Good answer.
We have gotten steak as an answer frequently, so I think there's a common theme here. But Van, we appreciate you taking your time. You know, an unpaid interview, a very organic conversation, and I want our listeners to reward your time by going to check you out. So my challenge to them is, if they think this is at all something their business or operation can use, to ask, to call and ask, because I was genuinely curious after we got this lined up. I know Dave coming in, his brain's already rolling. I could see it in his eyeballs. But ultimately, thank you again, Van.
Thank you, guys. I really appreciate being on your show. And by all means, 831b.com is the best way to start with us. And you know, you can be anonymous there and look at the videos and everything else and see if it's a good fit for you. But I think, you know, if you're any kind of risk taker, you owe it to yourself to look at tools like this. I can't reiterate it enough. So thanks again, you guys, for letting me be on your show. I really appreciate it.
Hey, it was our pleasure. Listeners, we thank you. We look forward to your feedback and questions so we can get Van on again. But until next time, have a good one.